Your World at 10. Now, there's been conflicting data from the U.S. economy for the past few weeks. GDP growth for the second quarter has slowed to 2.4%. And according to the latest jobs report, the U.S. economy lost 131,000 jobs in the month of July. The manufacturing sector is slowing, but auto sales are up. Overall, services sector is strong, but retail sales are weak. And the two consumer confidence indices are moving in opposite directions. Well, to make sense of this picture, of all this conflicting data that's coming in and what it means for the U.S. economy, we're joined by Lakshman Achutan, Managing Director of the Economic Cycle Research Institute, or ECRI, that is. Lakshman, thanks very much for your time. So what do you make, firstly, of the jobs numbers that came in today? And then I'll come to you about the various sets of data that we've been seeing over the course of the last few weeks.
Sure. Well, first, the jobs report. I'd say it's a mixed bag, and that's very disappointing. At this part of the recovery, because everybody wants to see some jobs growth that is strong enough to reduce the pain of the jobs lost during the recession, and we're not having that yet. We do have another month of the private sector adding jobs to the economy, and so that's been happening all year. Ultimately, that has to happen in terms of the recovery being one that is sustainable. But what you're already seeing is that the pace of private sector hiring, is not ramping up. It's not accelerating, and I think that fits very much with our view, and it has been our view since the beginning of the year, that the economy itself would begin to slow around mid-year. So even though we've ended the recession and we've had a spurt of recovery, that pace of recovery is already throttling back, and that's happening way before any significant healing in the jobs market has taken place.
So this disappointing number is mostly due to the Sensex workers moving out and therefore a loss of jobs in the government sector, but actually an addition of jobs in the private sector. So actually, on balance, this is probably encouraging, or at least status quoist, and not as bad as it looks. Is that correct, Lakshman?
Yeah, it's a mixed bag. I'm not going to say it's not bad. It is a mixed bag. We would have liked it to be a lot stronger. An important positive from today's report is private sector hiring continued for another month. That's been happening all year, and that is absolutely critical. If that was not happening, I'd be much more negative on the outlook. Another positive from today's report was that the work week got a little longer for everybody who is working, and that's a little bit of a leading indicator of the jobs market. However, you're saying it's a mixed bag, and I think you're right. Another leading indicator inside the jobs report is the number of temporary workers who are hired, because that tends to lead a full-time hiring position, and those actually fell. We lost jobs there. So the recovery continues, but it's slowing already, and that's disappointing.
What would you attribute, Lakshman, to the slowing of this recovery? I mean, you said you forecasted that there would be a slowing in the middle of the year. Why did you expect that? What are the contributing factors? Why are we seeing so much divergence in the data? Why is one consumer confidence index saying there is increasing confidence amongst consumers, and the other one saying quite the opposite?
Well, first, to why we were forecasting a downturn is simply based on leading indicators. That's what we do in studying recessions and recoveries, is use indicators like the weekly leading index to forecast growth rates in the economy and recessions and recoveries as well. And our weekly leading index, it hit a 2.25-year high back in April. And then it plunged for 2 months. And that had a lot of observers saying, well, that means there's a double-dip recession out there, but not so fast. If we go by our objective methodology that we've used for 3 generations, we didn't make it up today, it's premature to forecast a new recession, because the decline in the index has only been for a couple of months, and in the latest month, it's actually stopped declining. It's gone flat. And when we look at the pattern of growth coming out of recessions, you always have a spurt of growth from the depths of the recession, and then a throttling back. And about half of the time when you have the throttling back in growth, it turns into a new recession, and half of the time it's a soft landing. And that's why there's so much tension and so much mixed messages in the data, is because it probably hasn't been decided which one of those outcomes is going to happen.
Which one of those outcomes are you betting on? I do know that in an interview that my colleague in CNBC US, Phil LeBeau, did with President Obama just a day ago, President Obama said he was pretty confident there was going to be no double dip. Do you agree with that?
I don't think I can be that confident. Looking at the objective data, we have a very clear cyclical downturn in the economy that has not run its course. It is going to slow more through the end of the year. And I think that much is baked in the cake. The open question is whether or not it goes into a new recession, fulfilling this double dip kind of term. And there, I'm not willing to say it's a done deal, we're going to have a double dip recession, but I think the risk of another recession maybe in next year is reasonably high here, and we need to see things like the weekly leading index continue to stabilize. They've stabilized for a month, and we need to see another month of them stabilizing, and then I think I would be more inclined to agree with the president. But right now, I just don't have the objective data to have that level of conviction.
Lakshman, you're saying that this slowdown might continue till the end of the year. At least that's what the indicators tell you. When do you see a recovery, if at all? Is it early next year, the middle of next year? Because I think most people are trying to understand when that recovery will happen, or stabilization, as you pointed out. Notwithstanding the fact that maybe for the next several months or quarters, we will continue to see a very weak jobs picture, because like everyone's been characterizing this as a jobless recovery.
Right, and you know, to give some context to the jobless recovery, we lost well over 8 million jobs, and of those jobs lost, we've regained 7% of them. So, you know, 93% of the jobs lost are still lost. That's why it's a jobless recovery. When I look at all the indicators, forward-looking indicators, which are not jobs, on the U.S. economy, they're all pointing down still. Okay, they haven't turned up yet. There's only one very long leading indicator of global industrial growth. Okay, it's not U.S. specific, it's for the entire world, for the entire world's industrial growth cycle. And there we do have what looks like an upturn, which would be pointing to some sort of bottoming in global growth, and upturn by, say, the second quarter or the midpoint of next year. So we have a lot of ground to cover before then, and I think there's going to be a lot of people very worried about double dips in the meantime.
Final question to you, Lakshman, and I'm just curious to know where you stand on this whole tax debate that's been going on in the U.S. with regards to maintaining some of the Bush-era tax cuts, how to treat the next or emerging tax policy, and really what kind of exacerbating effect it may have on an already slowing recovery.
Yeah, I mean, from a business cycle perspective, we don't have any particular insight as to what policy, should we raise or lower taxes or spending. Those are all things for the elected officials to figure out. But what I can say with clarity is that there are some times during the business cycle when it's a good idea to tamp on the brakes, or when it's safe to have more restrictive policies, be they tax policies or spending policies or interest rate policies. And there are other times when it's very dangerous. And right now is not the time to have restrictive policies, be it with interest rates or spending or taxes. I'm not suggesting budgets don't matter. They very much do, and they have to be addressed. However, the right time to do that is when the economy is in an upturn. And right now, it's not. The growth is slowing.
All right, we'll let that be the last word. Lakshman Achuthan, always great to have you on the show. Thank you very much for your time. With that, we need to take a quick break on Your World at 10. We're going to come back.